Yeah, hello students. So welcome to this new session, and we are together understanding, or rather I am helping you understand and walking through the various chapters of ICWA final paper 20A, which is about strategic performance management and business valuations, in short called as Spm&Bv. And we are together for the entire session series of the subject. And today in today's session, so as the session series one by one I am completing. We have almost done with 8 modules, and the 9th module is on, and in that today the 9th module is all about valuation in mergers and acquisitions, and in that there are 3 chapters. So I'll be starting with acquisition pricing, how the pricing is to be done of the business when the corporate restructuring involves acquisition. So let's understand the acquisition pricing concept as such. So introduction. So again, as a matter of practice and as I have been advised, I have restricted myself to the study material only that has been provided, and more specific, the session will cover the entire chapter that is there in the study material, and in a way my PPTs which are being flashed during the session will include the summary, concise concepts, and in a way short notes of the entire chapter as such. So the intent is to help you with some kind of study notes in a crisp, concise and precise manner that can act as a guiding force for your examination preparations. However, if you want to further deep dive into the study material, then you will have to refer to the deep dive into the chapter, then you will have to refer to the study material in detail. Obviously, I haven't covered in any of the sessions the problems, illustrations, solutions and question and answers per se. Only thing is I have covered the short question answer and long question and answers that are there at the end of the chapter. What are the concepts that are being discussed and the key aspects of those concepts. Yeah, so with this background and context, let's begin with today's session, and today's session is all about acquisitions pricing. In that first, again as I said, it's a study material that I have referred. In the study material, the first concept which is talked about is business restructuring. So let's understand what is meant by business restructuring. Business restructuring means companies restructure their overall corporate structure to improve efficiency and competitiveness. Restructuring can be organic, that is internal, or inorganic, that is external. So organic restructuring includes aggressive marketing. So it's more of operational improvisation of the efficiencies and operational competitiveness to be brought into in organic restructuring. So organic restructuring includes aggressive marketing, expanding geographically and developing new products. Inorganic restructuring involves mergers and acquisitions, that is popularly known as M&A, and often considered faster routes to achieving business goals. So that's all about business restructuring. So business restructuring, in a way, it can be organic and inorganic. Organic is all about internal and inorganic is all about external. Then comes mergers and or amalgamations also. A merger involves 2 or more companies combining into one. The absorbed company ceases to exist. And the resulting company is referred to as the amalgamated or transferee company. So there are 2 types of mergers, or in merger typically let's say there is a company A, there is company B, and in such scenario, if the A and B merges together and forms A and B company, then it's called as a merger. And if the resulting company and if the one of the company absorbed company ceases to exist, then it is called as merger, and the resulting company is referred to as the amalgamated or transferee company. So there are types of mergers. So depending on how the merger is happening, accordingly the type of merger gets defined. So horizontal merger, in this horizontal merger are typically merger between companies offering similar products or services. Example, Vodafone India and Idea Cellular merger happened in 2017. Worth $23 billion. Now this merger is between 2 companies that are into the same product or services and were the biggest players in telecom industry. That's why it's called as horizontal. So basically, when the merger happens between the companies which are offering similar products or services or are in the same industry, then typically it is called as a horizontal merger. In vertical merger is basically between companies at different stages of value chain. Example, Disney acquiring Pixar in 2006 for US dollar 7.4 billion, and the companies are in different points in the value chain. So if at all, so the merger is happening vertical. So a small company in the lowest or the low in the hierarchy company in the value chain gets merged with the higher company in the value chain. So that's what is vertical merger. And example wise, it's Disney acquiring Pixar. Forward integration is another type of merger. In this, acquirer moves closer to the end customer. Example, let's say ice cream manufacturer acquiring restaurants. So in a way, this is ice cream companies getting merged into a restaurant means a forward integration. Because by merging into a restaurant, the ice cream reaches to the moves closer to the end customer. Backward integration over here means acquirer moves towards raw material resources or raw material sources. So in the similar example, if the ice cream company manufacturer acquires a dairy farm, then it is a backward integration. It is going back to the source of raw material itself. And raw material for ice cream company is typically the dairy farm service raw material provider. Conglomerate or diagonal merger or opposite merger also it is called as. So merger between unrelated businesses or industries typically is the case of conglomerate or diagonal merger. In this case, the merged companies are neither into the same products or services, nor in the same business, nor are part of the same industry. So it's totally diagonally opposite or irrelevant in a way also, one can say. So let's say in a way a company which is into IT acquires a company which is into manufacturing industry, then it becomes a conglomerate or diagonal merger, because in a way it's more of a option of diversification strategy that is being followed. So whenever there is a diversification of businesses that a particular group of companies wants to do, they get into conglomerate or diagonal merger. So these are the types of merger. Then let's understand what is meant by acquisition. So in acquisition, obviously both, so one company acquires the other company. Both the acquiring and acquired companies continue to exist as separate legal entities. The acquirer is the company making the purchase, and the target or acquired company is the company being purchased, which is a subject matter. So if A company acquires stakes in the B company, then it is called as the acquisition done by A company of B company. So in this, A is the acquiring company and B is the acquired company. B is the subject matter and A is the acquired company. A is purchasing B, in short. Examples of major acquisitions that have happened in recent past are Walmart and Flipkart, so which happened in 2018. So over here, Walmart acquired almost 77% stake in Flipkart India for US dollar of 16 billion. So that was the consideration or the acquisition price that was, or the purchase price that was paid to Flipkart owners. So Walmart acquired Flipkart India for 77% stake, not 100% but 77%. And for this 77%, Walmart paid US dollar 16 billion to Flipkart's promoters or shareholders. Second example of major acquisition is Facebook WhatsApp in 2013. So Facebook acquired WhatsApp for US dollar 19 billion. So in a way, WhatsApp was an independent company, Facebook was an independent company. But Facebook acquired WhatsApp for US dollar 19 billion. In a way, purchased WhatsApp in 2013 and paid 19 billion US dollars. Third example is Tata Motors Jaguar Land Rover in 2008. So Tata Motors acquired Jaguar Land Rover from Ford. So it's a business or a brand which was purchased by Tata Motors. That is also acquisition. and JLR from Ford. So Ford was the owner of JLR, and Tata Motors acquired JLR from Ford for a US dollar of 2.3 billion in an all cash deal. So that was a consideration that was paid upfront by Tata Motors to buy out the Jaguar Land Rover business. Then comes Byju's acquisition. So Byju's acquisition in 2021. Typically Byju's was owned by Think and Learn Private Limited company and acquired several edtech companies like Akash Educational Services Limited, Great Learning, Epic, Tinker, Scholar, Topper, GradeUp, HashLearn, Woodat, GeoGebra and White Hat Junior. So all these companies were acquired by Byju's for various consideration. Part of its strategy was to expand rapidly in the educational technology factor. So what happened over a period of time, when edutech companies started emerging, there were a lot of small education tech companies which came up like Akash, Great Learning, Epic, Tinker, Scholar, Topper, GradeUp, HashLearn, Woodat, GeoGebra and White Hat Junior. So all these were part of education tech companies only or industry, and Byju's acquired all these tech companies one by one, and now they are part of the Byju's group. So part of its strategy is to expand rapidly in the education technology sector. So that was the Byju's plans or business goal or business strategy, and therefore it went on acquiring all small education edutech companies which were around in the business environment. So motives for mergers and acquisitions. So what are the motives for such external restructuring? Typically M&A. One is the growth. So it enables faster expansion than internal development. Useful when the target company has the needed competencies and resources. Creation of synergy. So combined entity is more valuable than the sum of individual arm firms. Synergies may be cost based or revenue based and can improve cash flows through operational efficiencies or revenue gains. Increasing market power. That could be the another motive. So by mergers and acquisitions, acquiring competitors enhances pricing power in concentrated industries, and vertical integration can strengthen control over supply chains. Another motive is of such external restructuring is acquiring unique capabilities and resources also. So access to specialized R&D, marketing expertise or talent could be the one of the unique capabilities, acquisition of unique capabilities and resources, and thereby it avoids time and cost of developing such capabilities internally. Another motive, which is major motive of external restructuring, would be diversification. So over here it reduces dependencies on a single market or a product line or services, and thereby spreads its wings and risk by entering unrelated or new industries also. So in a way, diversification can be a risk strategy. So instead of depending on a single product line or a single industry only, the company decides or group of company decides to acquire and de-risk its strategy by diversifying into various industries and businesses also. So these are the motives of mergers and acquisitions: external restructuring, growth, synergy creation, market power increasing or increasing market power, acquiring unique capabilities and resources, and diversification. So now let's get into the main topic. So this was introduction to the types of external restructuring that can happen: merger, amalgamation, diversification, acquisitions, etc. Now let's get into how pricing is being done in case of acquisitions. So acquisition price and payment modes. The acquirer pays a price per share to acquire the target company. So in the examples that we saw in the earlier slide, let's say Walmart bought Flipkart India, and they took 77% of stake or shareholding of the Flipkart India from the Flipkart India promoters. So in that case, the cost for 77% shareholding, that is per share, was identified, and therefore the acquirer paid a price per share to acquire the target company. And target company, so here in this case the acquirer was the Walmart. So Walmart paid a price per share to acquire the target company, which is Flipkart India. The target shareholders, that is Flipkart India shareholders, receive compensation in cash or acquirer shares or both. So depends on the kind of structuring that has happened and agreement of consideration being paid. So in lieu of cash, there could be acquirer shares that can be given. So it could be a combination. So in short, the target shareholders receive compensation for the stake sale in either in cash or by way of acquirer shares or both. The final acquisition price is usually the result of negotiations between acquirer and target shareholders. So in our case, Walmart is the acquirer and target shareholders will be Flipkart India's promoters. Payment may come from the acquirer's assets, debt or issuance of new shares. So acquirer may, for buying the shares of the target company, will need to raise funds for itself, and that raising of funds can be done by way of acquiring assets, by way of selling the assets of the acquirer, or by seeking debt, or by way of issuance of new shares. So in share-based deals, the exchange ratio determines the number of shares target shareholders receive. So at times, as a part of consideration, there could be share-based deals. So the exchange ratio between the target shareholder shareholding in target company vis-a-vis the acquirer shareholder, against which how much acquirer's new shares will be issued. So that's the exchange ratio that is determined as a part of consideration. So then let's look into the components of acquisition price. So components of acquisition price includes book value of equity, so net assets as per accounting books. Second is the intangible assets not recorded on the target's balance sheet, and goodwill. So goodwill typically represents the acquisition premium, which is excess of purchase price over the fair value of the target company. Then comes the concept of hostile acquisition and acquisition premium. So hostile acquisition occurs when target management raises the acquisition, acquirer offers a price higher than the current market value to persuade the shareholders to sell the stakes to the acquirer. The acquisition premium is the difference between acquisition price and the market price. So typically the acquisition in a way is like forced, and that's why it's called as a hostile, or to some extent it is persuasive rather than forcing, and this persuasion is by paying higher premium more than the market price also, which is called as in a way the acquisition price. So the acquisition premium is the difference between acquisition price and market price. So in a way acquirer is willing to pay more over and above the market price of that particular target company, and that is called, that extra price is called as acquisition premium. From an accounting perspective, this premium is recorded as goodwill. So in such acquisitions, what is the value creation in acquisitions that happens? So value is created when combined company cash flows exceed the sum of the individual companies. So when they were standalone companies, whatever that cash flows that were getting generated by the individual companies, when the acquisition happens, then what is the value created when combined company cash flows exceed the sum of the individual companies? So if the value is created when combined entity cash flows, let's say, are 3, and which exceeds in a way the sum of individual companies. So individual companies cash flows were 1 and 1, so 1 plus 1 2, and if the combined combined company cash flows are like 3 and more than 2, then it can be considered that there is a value creation that has happened because of the acquisition. Value created therefore is equal to standalone value of target plus value of performance improvements minus market value of target plus acquisition price, acquisition premium. Plus acquisition premium. So that's how the formula of value creation can be arrived at. So purchase value and synergy value. Typically purchase price is usually higher than the intrinsic value of the target company. Therefore formula wise intrinsic value is equal to net present value of future or value of expected future cash flows. Market value is equal to current share price, reflects investor sentiment and acquisition likelihood. Synergy value is equal to additional cash flows expected from combining businesses, and value gap is equal to difference between intrinsic value and the purchase price. So this is how purchase value and synergy value can be arrived at. The premium analysis, that is the acquisition premium, is equal to deal price or the acquisition price minus pre-merger market price of target company, expressed as acquisition premium percentage equal to deal price minus pre-merger price divided by pre-merger price. So that's the percentage of acquisition premium that is going to be paid by the acquiring company to the target company, or acquiring target company to the target shareholders. So historical premiums from comparable deals help estimate reasonable acquisition premiums. Strategic deals, example Microsoft and LinkedIn, often involve higher premiums due to synergies. Then comes, let's understand analyzing value of the target to the acquirer, rationally for paying more than the market value. Why does the acquirer want to pay more than the market value? So acquirers pay more above market value if expected synergies, example cost savings and sales growth, exceeds the premium that is required to be paid, or takeover premium. So if the expected synergies or the value creation that will happen to the market value exceeds the takeover premium, then the acquirer is willing to pay over and above the market value. So in this case, acquirer's gain is equal to synergies minus premium paid. So formula wise, gain is equal to S minus PT minus VT, where synergies is S and PT is the deal price, that is the price paid for target company, and VT is the pre-merger value of the target company. Bid range in mergers and acquisitions. So in realistic world, the minimum price acceptable to target is equal to pre-merger market value. That's the minimum price that acquiring company is willing and acceptable to pay for the target company, and maximum price acquirer is willing to pay is equal to pre-merger value plus estimated synergies. So the extra price that is the acquirer is willing to pay over and above the market value is for the estimated synergies that the acquirer feels are likely to happen because of merging with the target company. So effective merger valuation therefore requires both pre-merger valuation and synergy assessment also. Then comes in terms of consideration in the mergers and acquisitions, so choice of payment method. So acquirers often use stock payment to share merger risk and reward with target shareholders. Cash payment is preferred by confident acquirers, stock preferred by target seeking future upside. Cash deals tend to result in higher returns for both parties in the short term. Stock deals can cause share dilution and often lead to a decline in acquirer share price post announcement. Thank you. धन्यवाद. Now let's look into a different concept of accretion or dilution analysis. So accretion or dilution analysis involves the purpose of accretion or dilution analysis is to assess the impact of a deal on acquirer's earnings per share. So if at all the merger is happening, then what is the impact that is likely to happen of the deal on acquirer's EPS is accretion or dilution. So whether there is a accretion that is going to happen or dilution that is going to happen in the EPS, earning per share of the acquirer company. So in a deal can be constituted as accretive if the post-merger EPS is greater than the pre-merger EPS, then it can be called as the deal adds value for acquirer shareholder. Dilutive deal is when post-merger EPS is less than pre-merger EPS. In a way, then it means that it has reduced the value for the acquirer shareholders. So thumb rule for all such stock deals is that buying a lower PE target company is always accretive. Buying a higher PE target company is always dilutive. So that's the thumb rule. Acquirers aim for accretive transactions to ensure shareholder value creation, of course. Then let's understand the earnings multiple. So obviously there is a separate chapter on earnings multiple which is there in already covered in module 7, I guess. And however, it is again iterated in the acquisition pricing also. So let's understand what is meant by earnings multiple. So overview of market-based valuation. It is based on the principle of substitution. So a buyer will not pay more than the cost of acquiring a similar substitute. That's what market-based valuation is. So based on principle of substitution, a buyer will not pay more than the cost of acquiring a similar substitute. It uses market prices of similar businesses to estimate value. The two key methods are transaction multiples, which is based on prices paid in the past mergers and acquisition deals, and guideline public company multiples, which is based on valuation of a similar publicly traded companies. Let's understand the two methods. Transaction multiples method includes or reflects investment value to a specific buyer, often strategic. Buyers are typically publicly listed companies and values usually incorporate control premium and synergy benefits. Whereas guideline public company multiples reflect minority interest valuations based on stock market prices. They represent market value and not the control value, typically used when valuing unlisted companies by comparing them to listed peers. Thirdly, the key valuation multiples involve enterprise value. Enterprise value, that is EV, the formula of EV is equal to market value of equity plus debt minus cash and investments, and therefore enterprise value reflects the total value of a company's operating assets. And second multiple is the price to book value ratio, P2BV, so P2B. So formula for that is price per share is equal to book value per share into PB ratio. It is based on the company's net assets, values and peer group multiples. Fifth key valuation multiple is the price to sales multiple, and in that formula wise its value is equal to sales turnover into price divided by sales multiple. So this price to sales of P2S multiple is useful when earnings are unreliable or negative. The best practices for using multiples includes choose the right multiple. So just a second, some presentation changes. So in a way, for choosing the best practice for using multiples is, these are the factors or the steps that are involved or criteria that should be followed for choosing the right multiple. Yeah, so the best practices for using multiples is choose the right multiple, which includes prefer EV upon EBITDA or EV upon no plat or over P to avoid distortion of capital structure and non-operating expense, non-operating items. So choosing the right multiple depends on the purpose of the valuation also. So while choosing the right multiple, use forward-looking earnings, whereby it reduces variations and reflects expectations better. Adjust for non-operating items, so normalize the data by removing items like excess cash or pensions, etc. Select the right peer group, so must match an on industry growth and return potential, that is ROIC. And sum of the parts valuation. So for multiple business firms, value each segment separately to reflect different performance drivers. Now let's understand the concept of discounted abnormal earnings or cash flows. So a quick overview. The purpose of adjustments in valuation are normally there are a lot of adjustments that are required to be done in the valuation. And over here, valuation why it is to be done is that because the valuation requires normalization of financial statements to reflect the true economic reality of a business. This is essential for both the target and acquiring companies, especially in stock-based mergers and acquisitions. And these adjustments therefore remove distortions caused by non-operating items, accounting policy and discretionary expenses. The common normalization adjustments included in valuations are non-recurring items like non-recurring items because they are like one-off kind of items, and hence they should not be considered in the calculations, and they should be in a way removed. So these are the common normalization adjustments. Removing of one-time gains, losses, example lawsuit settlements, asset sales, etc. because those are not recurring items and one-off items. Discretionary expenses, so the adjustment should be done in the valuation for excess compensation, related party transactions or tax minimization practices that would have been followed, because these again are discretionary expenses, not necessarily compulsory expenses or must expenses. Accounting method differences, so convert from cash to accrual, standardized depreciation, inventory methods also. So if at all there are two different accounting methods that are being followed by the target company and acquiring company also, or the companies which are involved in merger and acquisitions, then in such case normalization adjustment will have to be done for accounting differences in the accounting method of both the companies. And these differences are typically converting from cash to accrual and standardizing the depreciation and also the inventory method also. Fourth common normalization adjustment is about market versus book value differences. Reflect actual market value of assets rather than historical cost. So that's the purpose of these, because in a way it has to be normalized, the valuation, so as to come to realistic and justifiable, and with proper rationale there are certain normalization of adjustments that have to be done. So discounted abnormal, so continue with this concept. The key areas of for adjustments involves the financial statement. So in profit and loss account, exclude non-recurring or discretionary income and expenses. Ensure sustainable earnings are reflected in the profit and loss account. And in balance sheet, the areas of adjustments normally are adjust asset values to reflect market realities, identify and include contingent liabilities. And third adjustment that could be there in the balance sheet is recognize internally generated intangibles, example brand, IP, which are not recorded in the books. So intangibles normally are not recorded in the books, and therefore those items of intangibles might have to be recognized, internally generated intangibles not recorded into the books. Sorry. Just a second, my laptop has got shut down forcefully, so give me 2 minutes. Yeah, so we are looking into key areas of for adjustments for normalization that are required to be done in profit and loss account are just a second. Yeah, some technical hitch. Right. So in area, the key areas of our adjustments for normalization in the valuation are in profit and loss account are about excluding non-recurring or discretionary income and expenses to ensure sustainable earnings are that reflected in the valuations. Secondly, in balance sheet, one has to adjust asset values to reflect market realities, identify and include contingent liabilities, recognize internally generated intangibles, example brand IP, which are normally not recorded in the books. And thirdly, the promoting or controlling shareholder adjustments. So scrutinize the payments to promoters, loans to and from related parties, and rent of personal property, etc. So for these peculiar items which are related to promoter or controlling shareholders, adjustments will have to be done for normalization of the valuations. The asset valuation considerations typically will have to be considered. So intangible assets, revalue land and building to current market price, review property, plant and equipment for value in use or value in exchange. In case of investments, for investment asset value consideration, listed investments should be valued at market value. Unlisted investments need independent valuation, and separate operating from non-operating investments. In case of current assets, adjust inventory and receivables if turnover is slow or valuation method is outdated. Review provisioning for bad debts and obsolete stock. Asset valuation consideration for intangible assets includes internally generated intangibles like brands are not usually on the balance sheet. Acquirer can recognize such intangibles in post-merger consolidated financials. A professional valuer may identify and assign values to hidden or undervalued intangibles. Then let's understand acquisition for private equity and venture capitalists. In that, types of acquisition typically done by private equity and venture capitalists involves strategic acquisitions. So these strategic acquisitions wherein acquirer runs the largest post-acquisition the target post-acquisition. It is aimed at operational synergies, management, product and process changes. It involves high integration and often disrupts existing operations. May be seen by the target as intrusive. So these are typically strategic acquisitions, and in financial acquisitions commonly undertaken by private equity or PE, venture capitalists, VC or portfolio investors. These are focused on value realization rather than integration. Minimal operational interference is there in such financial acquisitions, and it is welcomed by targets companies who are in need of capital but with high growth potential. Because it's all about finance acquisition, in a way the PE or the venture capitalists or the private investors is more providing finance to that particular business or the business potential, and is not interested at all to get involved into and interfere into the day-to-day operations, is what financial acquisition is. Whereas strategic acquisition, typically the acquirer intends to run the targeted target company post-acquisition, and therefore it looks into or aims into operational synergies wherein management, product and process changes will have to be done. It involves high integration and often disrupts the existing operations. May be seen by the target as a intrusive step also. So normally the PE firms do not run daily operations but focus on governance and performance oversight. They emphasize value creation through strategic input, stronger performance culture, quick and efficient management, and normally has long-term vision, especially 5-year horizon versus 1-year horizon for public companies. Sources of value creation in PE acquisitions, typically according to a McKinsey study of 60 private equity deals, the observations that have come up from that study is that 2/3 of the value creation came from operational performance improvements, enhanced governance and better owner management collaboration. Less emphasis on financial engineering, leverage, buy low and sell high, and less emphasis on market timing also. The governance differences between PE, that is private equity versus public company, is that PE firms focus on strategy and performance management, whereas public companies often emphasize compliance and risk avoidance. So PE boards are more action oriented, not bound by rigid public market governance structure. So the distinction between strategic versus financial buyers, in a way that's the underlying between PE and public company. It clearly distinguishes the strategic and financial buyers' intent and underscores how private equity firms act as hands-on investors without getting into micromanaging, prioritizing value enhancement via governance reforms and strategic clarity. So that's the summary, you can say, between acquisition by PE and public companies, or the governance differences as is. So with this, in a way, we have come to end of the chapter, and as a matter of practice, or I have been covering in the sessions the short answers and long answers concepts that are being discussed, which are there at the end of the chapter. So in the short question answer number 1, the approach for company restructuring has been discussed. So in that, typically define rationale for restructuring, identify growth areas and synergy opportunities, explore ways to increase market power, leverage unique resources and capabilities, choose appropriate merger type, either horizontal, vertical, backward integration, forward integration or conglomerate also. And lastly, evaluate both internal and external environmental factors. The second question deals with type of mergers, entertainment and animation, in case of entertainment and animation industry. So vertical merger, so let's say company A is entertainment, company B is animation studio. Then it's a vertical merger, thereby it will help control content supply chain and therefore enhances value chain integration and quality content acquisition. Then in third short question and answer, the horizontal versus vertical merger has been discussed. So horizontal means same industry merger. Example, Vodafone and Idea, both were part of telecom industry only and big players of telecom industry. Same product, same service, same business. Vertical, different strategy with different stages in value chain, example Disney and Pixar. So they are part of the vertical chain, value chain, and the lower level entity gets merged into the upper level entity. So that's how the vertical merger happens. Horizontal improves market share, vertical enhances the supply chain efficiency. So these are the distinctions between horizontal and vertical mergers. Now typically in case of horizontal it will be same business line, and in case of vertical obviously it will be same business value chain only. Reasons for inorganic growth typically normally are the purpose is to have faster expansion, access to unique resources and capabilities, and market power increase, and realization of synergy is not possible through organic growth, and therefore inorganic growth is looked upon as a part of restructuring. And inorganic growth is the external restructuring. Then short question and answer 5 dealt with backward and versus forward integration. So in backward integration, company buys suppliers. Example, ice cream maker buys dairy farm because dairy farm supplies raw material to the ice cream maker. So therefore, in a way, ice cream maker is buying the supplier, that is dairy farm. Forward integration involves company buys distributors, customers. Example, ice cream maker buys restaurant, because with this the ice cream maker wants to go more closer directly to the near to the customer. So that's what it wants to eliminate the in between agents or add-ons that have happened in the distribution channel. So that is forward integration. So both integration aims to control more of the supply chain. Then in short question answer number 6, the concept that is discussed is about conglomerate merger purpose. Now in conglomerate merger purpose, also called as diagonal merger or opposite merger, it reduces the business risk via diversification. So the whole purpose is to have a diversification strategy or the risk diversification strategy. It opens up new market entry opportunities and broadens company's product or service portfolio. So the expanse of the company widens in a way because of conglomerate merger. They venture or they acquire such companies which are not in the same business or products, and therefore the risk of single product line or service line gets diversified. Walmart's acquisition of Flipkart was discussed in short question answer number 7. So the reasons was of Walmart to acquire Flipkart was to enter Indian market and thereby bring about e-commerce growth and compete with the Amazon as such. And in a way, this Walmart's acquisition benefited Walmart and Flipkart was with the larger customer base and strong brand presence in India. However, it faced challenges in terms of regulatory issues, market competition, and cultural integration also. In short question answer 8, practical use of integration, typically a brewery example has been considered. Backward acquires hop farm, that is raw material. Forward acquires pub chain, that is retail. So with this practical use of integration, the brewery company benefits gets benefits of cost control, supply security, and better market access. Creating synergy via mergers and acquisitions. So synergies include cost savings, revenue boost, and cross-selling also. Example, 2 bank mergers reduce the duplication of branches and staff and leads to economies of scales and operational efficiency. The last, that is the 10th short question answer which is discussed is success factors in mergers and acquisitions. So success factors are strategic goal alignment, cultural fit between the companies, and accurate valuation, detailed integration plan, and regulatory and legal compliance. So these are the key success factors in mergers and acquisitions. So with this, in a way, we come to an end of the session. But however, before closing down the session, I have a practice of summing up what we have covered in today's session in a quick summarization. So we started with 9.1 chapter, that is acquisition pricing. In that we saw acquisition, we first understood what is meant by demerger, merger, amalgamation, and acquisition per se, and thereafter we saw what is meant by acquisition price and payments mode. The acquirer pays a price per share to acquire the target company, Target shareholders receive compensation in cash or acquirer shares or both. The final acquisition price is usually the result of negotiations between acquirer and target shareholders. Payment may come from the acquirer's asset, debt or issuance of new shares. And in share-based deals, the exchange ratio determines the number of shares target shareholders receive. Then we saw the components of acquisition price, which includes book value of equity, intangible assets and goodwill also. So net assets as per accounting books, intangible assets are not recorded on the target's balance sheet, and goodwill represents acquisition premium excess of purchase price over fair value. Then we saw what is meant by hostile acquisition and acquisition premium. It occurs when the target management resists the acquisition. Acquirer offers a higher price higher than the current market value to persuade shareholders. The acquisition premium is the difference between acquisition price and market price. From an accounting perspective, this premium is recorded as goodwill. Then we saw the value creation aspects in acquisition. Value is created when combined cash flow, when combined company cash flow exceeds the sum of individual companies. So therefore, value to acquire is equal to value received minus price paid into price paid, that is the purchase consideration. So the formula is value created is equal to standalone value of target plus value of performance improvements minus market value of target plus acquisition premium. Then we saw purchase value and synergy value. What is the difference? Purchase price is usually higher than the intrinsic value of the target. Intrinsic value is equal to net present value of expected future cash flows, and market value is equal to current share price, which reflects investor sentiment and acquisition likelihood. Synergy value typically is the additional cash flows expected from combining businesses, and value gap is equal to difference between intrinsic value and the purchase price. Then we saw the whole concept of premium analysis. So acquisition premium is nothing but deal price minus pre-merger market price of a target, and is expressed as acquisition premium percentage is equal to deal price minus pre-merger price divided by pre-merger price. So historical premiums from comparable deals help estimate reasonable acquisition premiums. Strategic deals, example Microsoft, LinkedIn, often involve higher premiums due to synergies. Then we saw how analyzing value of the target to the acquirer means the rationale for paying more than the market value normally happens because acquirers pay above market value if expected synergies in terms of cost savings or sales growth exceed the takeover premium. And secondly, acquirers gains is equal to synergies minus premium paid, that is formula wise gains is equal to S minus PT minus VT, where S is synergies and PT is the deal price, that is price paid for the target, and VT is the pre-merger value of target. Then we saw the bid range in merger and acquisition. Minimum price to maximum price is the bid range that is given in mergers and acquisitions. So minimum price is the price acceptable to the target, that is the pre-merger market value, and maximum price acquirer is willing to pay is the pre-merger value plus estimated synergies. Effective merger evaluation therefore requires both pre-merger valuation as well as synergy assessment. In such cases, the choice of payment method is also unique, and acquirers often use stock payment to share merger risk and rewards with target shareholders. Cash payment is preferred by confident acquirers, and stock preferred by targets seeking future upside. Cash deals tend to result in higher returns for both parties in the short term, and stock deals can cause share dilution and often lead to a decline in acquirer's share price post announcement. Then we saw the accretion and dilution analysis and the logic behind it. The purpose is to assess the impact of a deal on acquirer's earnings per share. So accretive deal typically is the post-merger EPS is greater than pre-merger EPS. That means value addition has happened for acquirer's shareholders. And diluted deal is post-merger EPS is less than pre-merger EPS, which means that there is a reduction in value of the acquirer shareholders. So thumb rule for all such stock deals is that buying a lower PE target will be always accretive, and buying a higher PE target will be always dilutive. So thus acquirers aim for accretive transactions to ensure shareholder value creation. Then we went through earnings multiple. So in that earning multiples, we saw overview of market-based valuation based on principle of substitution. A buyer will not pay more than the cost of acquiring a similar substitute. It uses market prices for similar businesses to estimate value. And the two key methods are transaction multiples based on prices paid in past mergers and acquisition deals, and the guideline public company multiples based on valuation of similar publicly traded companies. Then we saw the transaction multiples method, which reflects investment value to a specific buyer, often strategic. And then buyers are typically publicly listed companies. Values usually incorporate control premium and synergy benefits. Then we detailed saw the guideline public company multiples. So this reflects minority interest valuations based on stock market prices. It represents the market value, not control value, typically used when valuing unlisted companies by comparing them to listed peers. Thereafter, we went through various key valuation multiples. One first multiple is the enterprise value. So in that, EV is equal to market value of equity plus debt minus cash and investments. And EV reflects the total value of a company's operating assets. Then we saw price to book value ratio. So formula wise, price per share is equal to book value per share into price to book ratio based on company's net asset value and peer group multiples. So price to sales multiple includes value is equal to formula wise value is equal to sales turnover into price upon sales multiple. So it is useful when earnings are unreliable or negative. Then we went through the best practices for how to choose multiples. So choose the right multiple, prefer EV upon EBITDA or EV upon NOPLAT over PE to avoid distortion by capital structure and non-operating items. Use forward-looking earnings, thereby reducing variations and reflecting expectations better. Adjust for non-operating items. Normalize data by removing items like excess cash or pensions. Select the right peer group. Must match on industry growth and return potential. That is ROIC. Sum of the parts valuation is another best practice for using multiples. For multiple business firms, value each segment separately to reflect different performance drivers. Then we went through the concept of discounted abnormal earnings or cash flows. The purpose of adjustments in valuation was looked into. Valuation requires normalization of financial statements to reflect the true economic reality of a business. This is essential for both the target and acquiring companies, especially in stock-based mergers and acquisitions. Primarily, the adjustments remove distortions caused by non-operating items, accounting policies and discretionary expenses also. Common normalization adjustments involves non-recurring items, removing one-time gains, losses, example lawsuit, settlements and asset sales. Discretionary expenses, so adjust for excess compensation, related party transactions or tax minimization practices. Third, normalization adjustment is normally on account of accounting method differences. So convert from cash to accrual or standardize the depreciation or the inventory methods also. Another common normalization adjustment is market versus book value difference. So reflect actual market value of assets rather than the historical cost. Then we saw the key areas of adjustment in profit and loss account. Normally excludes non-recurring or discretionary income and expenses to ensure sustainable earnings are reflected. Balance sheet wise, adjust asset values to reflect market realities. Identify and include contingent liabilities. Recognize internally generated intangibles, example brand IP not recorded on books. Promoter or controlling shareholder adjustments. Scrutinize payments to promoters, loans to from related parties and rent of personal property. The various asset valuation consideration of intangible asset includes revaluing land buildings to current market prices, review property, plant and equipment for value in use or value in exchange. Investments must be valued. Listed investments at market value. Unlisted investments need independent valuation. Separate operating from non-operating investment. Current asset valuation should include adjusting inventory and receivables if turnover is slow or valuation method is outdated. And review provisioning for bad debts and absolute stock also. Intangible asset valuation consideration includes internally generated intangibles like brands or are not usually on balance sheet. Acquirer can recognize such intangibles in post-merger consolidated financials, and a professional valuer may identify and assign values to hidden or undervalued intangibles. Then we saw the various types of acquisitions. Primarily, strategic acquisition includes acquirer runs the target post-acquisition aimed at operational synergies, management, product and process changes, involves high integration and often disrupts existing operations, may be seen by the target as intrusive. In financial acquisitions commonly undertaken by PE, venture capitalists and or portfolio investors, these are focused on value realization rather than integration, and minimal operational interference welcomed by targets in need for capital but with high growth potential. So PE approach to acquisition includes PE firms do not run daily operations but focus on governance and performance oversight, emphasize value creation through strategic input, stronger performance culture, quick and efficient management restructuring, long-term vision 5-year horizon versus 1 year for public companies. Then we saw the sources of value creation in PE acquisition. According to McKinsey research study of 60 PEs, 2/3 of the value creation came from operational performance improvements, enhanced governance, better owner management collaboration, less emphasis on financial engineering leveraged by low, sell high market timing. The governance differences between PE and public companies involves PE firms focus on strategy and performance management. Public companies often emphasize compliance and risk avoidance. PE boards are more action oriented, not bound by the rigid public market governance structures. So thus the distinction between strategic versus financial buyers and underscores how equity firms acts as hands-on investors without micromanaging, prioritizing value enhancement via governance reforms and strategic clarity. Then we went through various short answers, question answers. One was about approach for company restructuring. Short question answer 2 was about type of merger in entertainment and animation. Third was about horizontal versus vertical mergers. And fourth was reasons for inorganic growth. Fifth was about backward versus forward integration. Sixth was about conglomerate merger purpose. Seventh discussed Walmart's acquisition of Flipkart, the reasons, benefits and challenges. And eighth question was about practical use of integration. And ninth was about creating synergy via merger and acquisition. And 10th dealt with success factors in mergers and acquisition, predominantly which involves strategic goal alignment, cultural fit between companies, accurate valuation, detailed integration plan, and regulatory and legal compliance. So with this, we come to an end of the chapter and therefore end of the session, because I have been following one chapter, one session, so that there is no overlap, and it's easy for study purposes also. And student might not or listener might not have to refer to more than 2 videos. It will be 1 video, 1 session and 1 chapter. So with this we will end a session today, or this session predominantly, and thus we have covered the chapter number 9.1, which is about acquisition pricing. So signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session with the new chapter. Stay tuned till then, keep studying, keep referring the study material per se for detailed problem solutions and illustrations and understanding of the concept. So signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session.